Hello everyone, investment scams rampant. Please vigilant and discerning. Do not trust information from unknown sources. Please make sure recognize two official Capital Securities community, Facebook, Capital Securities, YouTube, Capital Wealth Insights.
Hello everyone, I'm Dongjia Shen, Tony. Now let's get started with today's group discussion. Good evening. First, let's look at today's two topics. The first one is that Trump actually made another statement yesterday. He talked about quite a lot of things, but there was one part that was pretty surprising. He said once again that he wants to fire Powell. And it just so happened that the US stock market dropped again yesterday. Are these two things related? Actually, there's not much connection. We'll take a look and I'll explain a bit more in a moment, because honestly, there hasn't been much news in the market lately. So basically, whenever Trump says something, it naturally becomes the focus of the market. All right, let's move on. Let's take a look. Today, we're still going to do this. Regarding what we call sector rotation, today we'll be focusing on a more important aspect. Interestingly, right after we finished talking about it yesterday, the market reversed. So in a bit, we'll also give everyone a brief introduction about that. First, let's take a look at this. This is one of the earliest pieces of news. Trump said that he still might fire Powell, and that at some point in January, he could announce a new Fed chair. So, on Monday, he hinted that he has a preferred candidate to serve as the next Fed chair, but he hasn't announced it yet. Originally, everyone thought it would be Hassett. However, Trump himself also said that it's possible, so I think the chances for other people aren't very high. So, Hassett is probably someone Trump wants as a candidate, but after all, this still has to go through the Fed, and more importantly, it needs to be approved by a vote in Congress. Whether Hassett can get full support from the members of Congress is still a question. Compared to the others, maybe there's still a chance here. So I think it's basically down to these two people, which isn't really a surprise to anyone. And once they're in, what they're expected to do is carry out a large-scale rate cut, which is what Trump wants. Now, let's finish talking about Powell first. He explicitly stated that he might still seriously consider the possibility of firing the current Federal Reserve Chair, Jerome Powell. However, the significant problem is, first and foremost, that he wants to, The reason for firing Powell is that the renovation project at the Federal Reserve led to a lawsuit against Powell. But let's talk about this. The chances of actually succeeding are pretty low, because when it comes to legal cases, let's not talk about the relationship between the defendant and the plaintiff. But in theory, if you think you have grounds to sue, the higher your chances of winning the lawsuit, the sooner you should file it, rather than waiting a while before deciding to sue. If you wait for a while and then file a lawsuit, it usually just fizzles out. I think if you have even a little understanding of how lawsuits work, you can probably relate to what I'm saying. Okay, the second point is, when you file a lawsuit, you can't possibly file it yesterday or today. At the earliest, you have to wait until next week, maybe after work starts on Friday, before you can even begin to file. After you file, the court has to review it, then there are hearings and all sorts of procedures, and by the time all that is done, his term will probably already be over. So what's the point of all this? I really don't think it makes much sense. It feels more like Trump just venting his own dissatisfaction. On another note, there's another issue that comes up from what he's saying, and I think it's a bit troublesome. If Trump keeps bringing up this whole thing about the Fed's renovation project and the cost overruns, it could actually lead to a situation where, because Trump keeps talking about it, Powell just wants to protect himself and refuses to resign from the board. And the term for that board position would actually last until after Trump leaves office, so he'd still be in the position even after Trump is gone. If that's the case, let me tell you. So I think if Trump keeps using these reasons, you might actually see Powell and Trump butting heads all the way to the end. So whether this is actually good for Trump or not, I really don't know. I feel like Trump's remarks yesterday were probably a bit emotional. As for this, everyone should pay attention. The new Fed chair is expected to be announced sometime in January. The FOMC meeting is at the end of January. So will the announcement come before that? I think that's something to watch out for. Later, when we talk about the Fed meeting and the probability of a rate cut, we'll discuss this with everyone. There's a risk here that we need to remind everyone about today. Of course, yesterday, Trump was at Mar-a-Lago. After the press conference, there was a summary. He hosted Israeli Prime Minister Netanyahu at Mar-a-Lago, and after that, they held a press conference where they discussed many issues. The first was the Middle East issue, and he talked about Hamas. There's only a very short window for disarmament, and then they'll move into the second phase of the ceasefire plan, if I'm not mistaken. Well, maybe you've forgotten. This is actually, you probably forgot, so let me remind you. The Hamas ceasefire, the Gaza ceasefire, is actually divided into two phases, right? So when the ceasefire first started, everyone thought that the first phase meant everything was already calm and peaceful. But actually, now we're just entering the second phase, so there are still uncertainties here. However, I think for Trump, right now, besides the US itself and Chen Bin at Venezuela's doorstep, the only place in the world he really cares about is still the Middle East, specifically Israel. After all, Jewish people are the main financial backers of American politicians. So just take note of that. I think that's probably the only issue he truly pays attention to. The only thing he cares about, aside from the US, is probably just the Middle East issue. As for the Iran nuclear issue, he's still keeping an eye on Iran. If Iran rebuilds its nuclear capabilities and strengthens its missile program, specifically its missile plans, he might strike again. That's what I think. I think Iran probably won't actually go through with it. If they're working on missiles, they won't work on nuclear weapons. If they're working on nuclear weapons, they won't work on missiles. If you think about it, that's basically the gist of it. You know, because if you have both nuclear weapons and missiles, you could actually hit Israel. That's why Trump... So, to a certain extent, that's Israel's position. Before you can achieve that goal, they'll definitely take you out first. So that's basically a report on the situation in the Middle East. Also, he mentioned the Taiwan Strait. Honestly, after I saw what he said about this, I felt a chill, really. Why did it feel so discouraging? Well, he has a very good relationship with Xi Jinping, but Xi never mentioned this matter to him. I mean, how could he possibly bring up these military exercises with you, man? All right, and then they've been holding naval exercises in that region for 20 years. Yeah, it's true it's been 20 years, but they're getting closer and closer to Taiwan's territorial waters, which is another issue. But when Trump talks about it, he's clearly trying to downplay it, and that actually makes things really difficult. First, it's tough for Taiwan, and second, it's tough for Japan. So actually, if anyone has questions later, we can keep talking about this. Anyway, I can basically just tell you that when it comes to the Taiwan Strait issue and the military exercises, Trump is downplaying the situation. That's not really a good thing. Bauer should probably resign. He's also talking about the Russia-Ukraine situation, which is honestly another thing that leaves you feeling pretty cold. So he said that Putin told everyone that one of his residences was attacked by Ukraine. That should be Putin's villa, which is probably a vacation home. It's that kind of vacation house, you know, like a head of state's retreat. Usually these bigger countries all have some kind of vacation center. For example, the US has Camp David, right? So Russia probably has something similar. Apparently it was attacked by a Ukrainian drone. And about this incident, Trump feels extremely angry. This incident could become a new variable in the ceasefire between Russia and Ukraine, but let me tell you, this is probably just an excuse. Why? From the fact that Putin went to inspect the troops in full military uniform, you can tell Russia wants to keep fighting. I think the prospects for a Russia-Ukraine ceasefire between Russia and the US have already been settled in their talks. The one who can't accept it right now is Ukraine. But actually, it's not just Ukraine. It's Ukraine and its European allies who can't accept this reality yet. If that's the case, then there's a very likely scenario. You could call it fighting while negotiating, or you could say it's fighting until. It will only stop when someone in Ukraine or Europe really can't hold on any longer. So it's possible that the fighting could continue for another 3 to 6 months. It looks like the chances of it dragging on until the middle of 2026 are pretty high. So, on another note, Trump also stated that the US has, for the first time, carried out a strike on a facility inside Venezuela. This is very significant. He said this marks an escalation in US actions against drug trafficking. Why is this important? First, it's the very first time, literally the first time, that the US has struck a facility on Venezuelan soil, meaning on their land. Previously, any attacks were mostly on ships at sea, but now it's moved onto land. Like I mentioned, Christmas has already passed, and it's very likely that after the new year, the US might take further action. So this is something to keep an eye on. But let me add something here. Just make a connection here. The US is making moves against Venezuela, but you don't really see any other countries around the world speaking up about it. At the same time, China is making moves around Taiwan, and similarly, you don't hear much from other countries either. So there's a sense that these two major powers are trying to assert their dominance. That's definitely the vibe here. So everyone should pay attention to this. It's not that we want to talk about international politics, but rather that the economic situation has shifted to this point. International politics could become a black swan for the market at any time, so we still need to pay attention to it. Now, on another note, yesterday the index was relatively a bit suppressed. The three major indexes all closed down across the board, and the prevailing sentiment was one of panic, which mainly impacted tech stocks. Assets experienced sharp fluctuations, and I'll mention the situation with gold and silver in a moment. Of course, geopolitical tensions are a factor here, mainly referring to the issues involving Venezuela and the Russia-Ukraine situation. So the S&P closed lower on Monday, and for US stocks, there are only today and tomorrow left before 2025 arrives. That means there are just 2 trading days left this year, and stocks fell again this week. So some people have already, some foreign financial professionals have come out and said that it's possible the last few days of this year will end in a relatively calm, soft landing, just wrapping things up. I think that's quite possible because, first of all, if you look at the gains since the start of this year, they've actually been pretty strong. As of yesterday or last Friday, it was about 18%. Yesterday, there was a slight pullback, but really over here, after such a big run-up, it's quite possible that there will be some adjustment pressure before the end of the year. Even though institutional investors are on holiday, the thing is, there are still some individual investors who want to lock in their profits and play it safe. Yeah, there's definitely a motivation for profit-taking here. Also, looking at individual stocks, among the leading stocks, Nvidia and Palantir had the biggest drops. Meanwhile, the energy and real estate sectors led the gains. Now, you should pay attention to energy. Wasn't it just recently that after Trump met with the Ukrainian president, energy stocks took a big hit? But yesterday they surged again, probably because the situation with Russia and Ukraine didn't look good. But the thing is, the current situation is actually one of oversupply. There's an oversupply of crude oil, so that's something to watch out for. As for sectors, materials, consumer discretionary, and financials were among the biggest losers. We'll talk a bit more about materials in a moment. This year's Christmas rally feels pretty subdued. In fact, the so-called Christmas rally in the US stock market isn't really something people expect, because most people are actually off celebrating Christmas. Instead, it's the January effect that's more worth paying attention to. After the new year, once January starts, US stocks usually tend to perform better in that month, so we should keep an eye on whether this trend will continue into next year, 2026, and see if the same situation plays out. The January effect is actually more worth paying attention to than the so-called Christmas rally. Tech stocks and commodities have been relatively weak, so on Monday the S&P was down. This could be because trading volume isn't high enough, and it's possible that today and tomorrow we'll still see only small fluctuations. If it keeps dropping, I actually think there's no need to worry too much, because the overall upward trend hasn't changed. As for yesterday's leading gainers, Micron did really well, and then Texas Pacific, along with Energy and Verisk Analytics, were leading the way. The biggest losers were Newmont, Albemarle, and Tesla. The first two are commodity stocks we mentioned yesterday, and they experienced a sharp drop. It seems like there was some profit-taking and selling pressure. We want to especially mention, and we'll talk about this in a moment, that similar selling pressure is likely to exist. Let's quickly go over the other indices. The volatility index has rebounded. There are signs of a slight rebound, so in the short term, it could have an impact. The S&P Equal Weight Index is trending down, and the Equal Weight Index excluding AI also saw a small drop. As for the Dow Jones, it dropped for the day. The leading gainers were Chevron, Boeing, Walmart, and IBM. Chevron is particularly worth noting, because I took a look at other US energy stocks, like ExxonMobil, and then the others, like ConocoPhillips, and other oil companies, didn't see much of a rise. But as for Chevron, it probably has something to do with Venezuela. If I remember correctly, the oil fields that Venezuela nationalized before, Chevron was the one that went there at the time. They invested there. So if there really is a regime change, then the sovereignty over those oil fields might have a chance to return to Chevron. I think if it's not Chevron, then it's that other company. ExxonMobil, yeah, it's one of those two. So yesterday it was the leading gainer, but there were still more stocks that led the decline, since overall the market was down. Goldman Sachs, American Express, Caterpillar, JP Morgan Chase, and Amgen were among the losers. Also, over on the NASDAQ, it was down as well, dropping another 0.5%. Let's talk about this side for a bit. Over here, the market dropped about 0.41%. Micron was the top gainer, and then LabCorp, Extra LabCorp also went up. As for Intel, Intel also went up, but overall, out of all the stocks in the three major markets, only 8 went up, including those 3 I just mentioned. The good news is that the number of stocks that fell was relatively small. Besides Synopsys, there were only 6 stocks that dropped more than 1%. So this correction isn't really big. It's still considered pretty mild. It's the end of the year, so trading volume's pretty low, and the corrections are mostly happening to individual companies. As for the Magnificent Seven, most of them fell rather than rose. Only Apple had a slight increase of 0.13%, and Google edged up by just 0.02%. On the other hand, the ones that dropped were Microsoft, Meta, Amazon, Nvidia, and Tesla. Of course, the drop was quite significant, so the whole index went down. You can see that the index had a bit of a reversal, but basically it's still in an upward trend overall. So this is basically the pattern of shrinking volume and consolidation before the end of the year. Now, we need to especially add that London copper did go up. It surged at one point, but by the end of the session, it was actually affected by the decline in US energy and raw material stocks, so the gain narrowed to about 0.5. So this narrowing left a bit of a wick on the chart. As for copper, like we mentioned before, the US copper inventory is really too low, so there's a force driving restocking, which has helped push copper prices to perform better recently. In Taiwan, actually, there are some sectors that are included in this trend, it seems. The PCB sector, for example, has some momentum for price increases. Why? Because costs are going up. So here, I want to say that copper is something you might want to keep watching, because the supply and demand situation is trackable. It's something you can get a good handle on. So yeah. In addition, this year, copper has the potential to reach its highest price since 2009. The main reason is that since the start of this year, there have been several major unplanned mine shutdowns. For example, like I mentioned before, FCX, Freeport, had to switch plants in Indonesia. And then there were mining accidents, leading to shutdowns that are expected to last for quite a while. These are unplanned shutdowns. And then for some others, for example, complying with improved environmental regulations or scheduled maintenance or the addition of new equipment, these are considered planned shutdowns. Unplanned ones are usually due to mining accidents or strikes, so these unplanned events are more likely to tighten overall supply. Also, there's the impact of Trump's trade policies, and the smelters are under pressure, so copper prices have been boosted. So what we're saying here is that stocks related to price increases are still being anticipated. Now, this part is more important. Yesterday, after silver broke through $80, it started to fall sharply. Here, it says that the record rally driven by speculative demand from China has ended. But actually, when we look at the speculation, it's not necessarily just Chinese speculation. This speculation isn't limited to China. As long as there's speculation going on, believe me, when there's money to be made, it doesn't matter what race or gender you are, or even your age for that matter. Then silver at one point dropped by 9%. Well, it eventually fell more than 9% and finally closed down 9%. Gold prices also followed suit and dropped by 4.5%. Today, I see there's been a rebound, but I want to especially mention, first of all, that CME has started to raise the margin requirements for some futures contracts. After they start raising the margin, if the situation still doesn't improve, they might continue to increase it. This will come at the expense of gold and silver futures liquidity, which will have some impact on prices going forward. Also, I heard some news, though it hasn't been confirmed yet, that China seems to be imposing some restrictions. So this is something to watch out for. If silver is treated as a strategic core asset and they decide to control it, it would be just like what they did with rare earths. If metals like silver and copper, which have industrial demand, are controlled, all of these metals tend to be commonly classified as so-called strategic assets, and if they are controlled, price increases can become a real headache. This could lead to a more long-term and widespread price hike, which is something worth paying attention to. However, up to now, we haven't really seen this happen yet. Why? Because among industrial metals, aside from copper, silver isn't actually a primary one. When it comes to industrial metals, the more important ones are copper, aluminum, and nickel. As for tin and iron ore, in that area, well, nickel ore has been doing a bit worse recently, mainly because China produced too much nickel ore when developing electric vehicles, so there's actually an oversupply of nickel. As for lithium ore, it was mentioned yesterday that it's been relatively strong, but Albemarle also had a bigger drop yesterday. So for lithium, there's a higher chance that real demand is driving things. We'll keep watching this going forward. Some of these things, certain factors can trigger short-term strength, but honestly, after some regulations come in, things will generally cool down for a while. However, in the end, it always comes back to supply and demand. On the supply side, if we really see that if demand is clearly much greater than supply, then prices will still perform well. At this point, you really need to calm down a bit. Now, let's move on to the topic of interest rate hikes and cuts. As we mentioned earlier, we want to remind everyone about this. The January 28th Pilot General Meeting. This FOMC meeting, so if you look at the probability of a rate hike or a rate cut, you can pretty much be sure that there won't be a rate cut on January 28th. Also, we need to be aware of one thing. If Trump announces the new Fed chair before January 28th, then that good news will have already landed. The positive impact will have been realized once you know who the Fed chair is, right? The market will probably start speculating about how strong the actual rate cuts will be. Then, combined with January, if they don't cut rates and the guidance they give is for only a very minor rate cut, be careful. The market could experience some volatility due to disappointed sellers. This is definitely possible, so we're giving everyone a heads up here. All right, and also I want to remind everyone to pay attention. This year on the dot plot, last time there was only one break, and then the market is trading on the expectation that there is a probability of more than 2 rate cuts before the end of the year. All right, and in addition, we've seen some Bloomberg research, some alternative research data. According to estimates from conference calls, this year there should be more than... At most, there could be room for about 4 rate cuts, but we want to tell everyone. All these rate cut expectations are based on the premise that the CPI will continue to steadily decline. So in the short term, as I just mentioned, the concern is that I want to remind everyone that the expectations for rate cuts might be slightly adjusted. Why is that? Because you still don't have enough inflation data, you can't really make a judgment about the expectations for rate cuts. And if the employment numbers turn out to be bad, people will start worrying about a recession instead. So this is pretty important. So pay attention to this. The data can't be too strong, so strong that inflation, if the inflation pressure is too high, that's not good, but the data also can't be too weak. If it's too weak, then people will start worrying about a recession, and that's not good for the stock market. Now this year, let's talk about this. This year, the market's expectations might be higher. Why? Because prices have already gone up. This year is, let me tell you, this year is 2026, right? In 2026, the market will have higher expectations for all kinds of things, whether it's economic data or corporate earnings reports. Expectations might all be a bit higher. Why is that? Because from 2024 to 2025, the market has already gone up for 2 consecutive years. So by the 3rd year, I think the market's expectations will gradually start to form. So you really need to pay special attention to this. Sometimes a small piece of good news is actually good news, but bad news could really just be bad news. We just want to remind everyone here, okay? The main thing you need to remember is that after the Federal Reserve announces its new nominee for chair, together with the decision from the January 28th meeting, it will give you a clearer comparison. If the outlook on interest rates is conservative, the market might become more volatile as a result, and the pressure could be a bit higher. Also, there weren't many economic data releases yesterday, mostly just some B or even C level numbers, like pending home sales. And then in addition, There was also a regional Federal Reserve manufacturing index, and the regional index was actually quite weak, which is not a good sign. So tonight, the main things to watch are the ADP weekly employment numbers and the FHA house price index. And actually, the other two are also house price indices. As for the Chicago Manufacturing Purchasing Managers Index, not many people pay attention to that anymore. The most important thing is still the FOMC meeting minutes that will be released tonight or early tomorrow morning, so we should keep an eye on that. Even though Powell's term, his term should end in May next year, but is there still room for rate cuts before he steps down? That's something we still need to pay attention to. If there is a rate cut before Powell leaves office, well, if there is a rate cut this year, the record for rate cuts would be a bit larger. If not, and we have to wait for the new chair to take office, then there would be only about half a year left to cut rates. In that case, the extent of the rate cuts might be relatively smaller. So that's basically the situation here. And then actually the US dollar, roughly, starting from last week, there hasn't really been much change. Yesterday, there was only a slight movement, and before the market opened today, it was also just a small change. It feels like there really isn't much trading activity. On the other hand, the bond market has been the fluctuations have been pretty significant. Yesterday was the 2-year yield dropped another 2.45 basis points. Also, the 10-year yield, I think, fell a bit more. The main thing is the European bond market. Most European countries had a 2-day holiday. The 25th and 26th were But, well, the 25th is Christmas and holiday, and the 26th is also a holiday. In some places, the 24th, 25th, and 26th are all holidays, so they get 3 days off. That's why the European bond market only resumed trading on Monday and yields dropped, which in turn influenced the performance of US Treasuries. This is pretty rare, since usually it's US Treasuries that affect other markets, not the other way around. So it's other markets influencing changes in US Treasuries. Here you can see that the 2-year bond yield is down, and the 10-year is also down, with a bigger drop. But there's something else we want to mention to everyone. Recently, the volatility in bonds has been relatively small, but for this year, meaning the 2025 fiscal year, the overall range of fluctuations is still on the higher side. Now, what we want to point out to everyone is that the growth situation is still being maintained. The premise for the outperformance of stocks over bonds should still hold next year. It's pretty clear, so I think when it comes to bond investments here, hey, maybe you don't need to put in so much effort or pay such close attention. Today, an important part of our discussion is still about sector rotation. Wow, on Monday, we mentioned the raw materials sector, and actually that very day, the trend reversed. But what we want to talk about here is precious metals, especially this year with interest rate cuts, and how precious metals are performing because of those cuts. There will be some impact, but it will be relatively mild. Now, as for base metals, actually, as long as they have strong industrial attributes, the key issue is whether their supply and demand are out of balance. As long as there is more demand than supply, there will be momentum for price increases down the line. So we will continue to keep an eye on this. Today, we're going to focus on these 4 types of stocks: financials, healthcare, industrials, and core consumer goods. For industrials and core consumer goods, we'll start by looking at the smaller ones and work our way up. Also, we'll first take a look at financials and healthcare. This is important because it's more comparative. The big so-called new giant indexes, information technology is about 34.5, non-core consumer goods are around 10.5, and communication services are also about 10.5. We'll talk about these tomorrow since we need to go a bit deeper into them. So today, let's first look at finance, healthcare, industrials, and core consumer sectors. Here, I especially want to point out the tendency for sector rotation. When you look at the index weights, you can see that information technology dominates. This is actually quite similar to the structure of the Taiwan stock market, where the proportion of information technology is even higher. But it's the same in the US. Information technology also accounts for 34.5% of the index weight. However, we need to pay attention. If sector rotation is going to happen, it will definitely be the case that if one major blue chip stock drops, then 1 or 2 other sectors with relatively large weights will step up to take its place. That's why we keep emphasizing the importance of watching for sector rotation, because it's possible that there are some concerns about AI stocks themselves, like whether they might drag down the economy. You'll need to rely on other sectors to fill that gap, so that the overall index can either keep rising or at least move sideways with some volatility, or even experience a mild decline. That's why I'm specifically bringing this up to everyone. As for sector rotation, I talked about it yesterday, I'm talking about it today, and I'll still be talking about it tomorrow. First of all, let's take a look. The financial sector has the largest weighting, and if you add up communication services and healthcare, together they account for over 20% of the total weighting. So the performance of these two sectors will play a key role in controlling the market. In particular, if you want to manage the market, the financial sector is extremely important because it carries a heavier weight. Now, let's take a look at the current situation. Starting from the fourth quarter, healthcare actually performed first, followed by the financial sector. But here's something you might not have noticed and should pay attention to. Actually, since the beginning of this year, the financial sector has risen by 19.10, 9.06, almost 10, 9.91%. This is better than the overall index, which only rose by 17.4. So the financial sector has outperformed. So if we focus on it, we can see that in the fourth quarter, these sectors generally tend to perform well. But today, what we're going to talk about with everyone is some of the more specific stocks within these sectors. You might find it a bit annoying, but what we want to say is that for some of these stocks, after I tell you about them, if you pay a little attention, you'll realize that some of them are actually quite familiar to you. They're not completely foreign. When you look at them again, you'll see there are investment opportunities, especially if you're looking to pick a stock that's really strong and isn't afraid of some market volatility or sideways movement. If the market is consolidating, you should look for opportunities among these stocks. There are still chances to be found. Don't underestimate their potential performance. As for financial stocks, the main thing is that after November 20th, they went up by 8.5%. All right, now let's take a look. The main focus this year has really been on technology and financial stocks. So what's going on with them? The 6 traditional financial giants are JP Morgan Chase, Bank of America, Citigroup, Wells Fargo, Goldman Sachs, and Morgan Stanley. This year, their stock prices have risen by more than 45% on average. But why do we say this about the past few years? It means that in recent years, these stocks have been kind of underwhelming. Why is that? Because back then, what was popular were so-called alternative asset groups, like Blackstone, not BlackRock, which is the asset manager, but Blackstone, which mainly focuses on real estate. Then there's KKR, Apollo Global Management. These are some of the bigger ones. KKR is private equity, and Carlyle is also private equity. Overall, their stock prices mostly went down, except for Carlyle, which went up. So this led to a situation where, previously, the 6 traditional banking giants that used to get all the attention actually performed better this year. Okay, and we should also add something here. This year, among US financial stocks, the one that rose the most was Robinhood Markets. All right, so when the meme stocks first started, Robinhood was hyped up as the main platform for trading these meme stocks, which are basically stocks driven by internet influencers. The key selling point was that there were no transaction fees, and they probably used your data for that. They made profits from the bid-ask spread. Another one is Interactive Brokers, which is also considered a so-called low-cost discount broker. These two performed relatively well this year. On the other hand, when it comes to asset management giants, BlackRock only went up by 6.17% this year. But if you look at the big financial stocks, they generally performed much better. For example, Citigroup went up nearly 68%, Goldman Sachs 55.8%, Morgan Stanley 43%, JP Morgan Chase 35%, and Wells Fargo also did quite well. Bank of America was up about 32%. 25, 26%. So just to let everyone know, this year, large bank stocks have really regained their shine. There's something very important here. First, usually in the US stock market, because the US stock market is huge and there are a lot of stocks, the ones that really stand out and get the spotlight usually have a certain characteristic. After a period of strong performance, these stocks don't just suddenly weaken. They tend to gradually lose momentum and slow down. So you should pay attention. If financial stocks are still pretty concentrated right now, it might not be the end of the rally yet. In fact, there could still be a chance for continued gains. So keep an eye on that. Now, moving on to another point about financial stocks. When it comes to investing in US stocks, I still recommend that everyone choose large companies over small ones. Why? Well, let me explain. The US is a capital market, a capitalist country, and it's very clear that big companies have big company resources. So whether times are good or bad, large companies are generally more capable of weathering the ups and downs. It's possible that when things really take a turn for the worse, these big companies could end up being the ultimate winners. And when times are good, they're even more capable of swallowing up smaller but high-quality competitors. So this is something to pay close attention to. Also, when it comes to financial stocks, there actually aren't that many new types of businesses. Since there aren't many new types of businesses, usually large companies have their own advantages. So in the financial industry, I personally really prefer large financial stocks rather than buying some of the smaller ones. For example, take those regional banks that had problems before. Before anything happened, they were considered very high-quality banks too. But the issue is, once there's an asset mismatch, problems can arise. And sometimes there's no one to bail them out. So I wanted to point this out to everyone. So financial stocks do have their advantages. If you need to park your funds somewhere, or if you're rotating your investments, financial stocks are actually a very good option. Plus, they're highly liquid. Next up. Healthcare stocks have gone up 13.3% this year. Most importantly, we still need to focus on healthcare stocks. There are a few main categories within the sector. First, pharmaceutical stocks, and then healthcare providers. There are also drugstores, supplements, and what we call medical equipment. These are the general categories, though it's not a very precise breakdown. We're just trying to explain that, first of all, pharmaceutical stocks can vary a lot in performance. For example, Johnson & Johnson grew by almost 40%. Eli Lilly also grew by nearly 40%. But Pfizer dropped by 5.77%, and Moderna fell by 2.51%. So what we're saying is that within pharmaceutical stocks, the difference between the good and the bad is significant, and you really need to pay close attention to this. That's usually right. They are often influenced by certain star drugs, but this is a double-edged sword. The same thing that brings success can also bring failure. For example, Eli Lilly grew by nearly 40%, and another one, Amgen, should have also gone up. Yeah, both of these are rising. What's going up is weight loss drugs. Ever since weight loss drugs became a hot topic in the market last year or the year before, the buzz hasn't died down. But the problem is, when it comes to the overall progress of these drugs, the process of getting these weight loss drugs to market, it's actually not that fast. With new drugs, you just have to take your time and work through it slowly. Sometimes, besides needing guts to invest in new stocks, so-called new drug stocks, you also really need a sharp eye to judge whether or not this will actually succeed. And there's another thing you need: patience. Because if an experiment doesn't go smoothly and gets held up a bit at the FDA, that's easily a matter of 2 or 3 months. So after all the back and forth, half a year or even a whole year could just disappear like that. So that's something you need to pay attention to here. As for healthcare insurance stocks, we pay a lot of attention to them here. They're very important. This year, healthcare insurance stocks have actually performed pretty poorly. Only about 2 of them have seen significant gains. CAH should be Cardinal Health, which is the parent company of Cigna. HCA is another healthcare company, but there's also UNH and Molina. These 2 health insurance companies have actually dropped a lot, especially UNH. It rebounded for a while before weakening again. Now, when it comes to healthcare insurance, as you know, the US doesn't have a National Health Insurance Bureau. Everyone knows that. It's all private insurance. But the problem is, health insurance is really considered a necessity. As long as you have a job, it's very important. You basically have to buy health insurance. Otherwise, if you don't have it, then you better be prepared. Sigh, you'll end up as a casualty at the cutoff line, so you really need to pay attention to this. But what I want to point out here is that just because certain individual stocks or sovereign stocks didn't perform this year, it doesn't mean there won't be opportunities for them next year. That's something we want to remind everyone about. Another thing is the second category, which is drugstores like CVS and Walgreens. These drugstores, especially CVS, have actually gone up a lot this year. Then there are supplements and medical devices. There are really a lot of individual stocks in this area. You really have to pay special attention to them. For example, take Viatris, a major pharmaceutical company. They've launched a lot of nutritional supplements for fatigue and so on. You really need to look into those. But what we need to notice is that if overall consumer spending power in the US weakens, these nutritional supplements are more likely to be affected. Why? Because they're not really essential for daily life. So when people are strapped for cash, these are the kinds of things they might cut out first. So that's something to keep an eye on. Okay, moving on to the second category. After talking about finance and healthcare, let's talk about something else. Actually, this year, maybe quietly, without everyone noticing. Oh, sorry, I don't have that chart. I switched the chart. It's still the gold chart, but the industrial index has risen 19.1% this year. So what I want to tell everyone is the main thing about industrial stocks is that it's a very detailed sector with a lot of individual stocks. There are about 80 in this group. Okay, healthcare has about 60 something. And then this one, financial stocks also only have about 60 something. So there are more industrial stocks. Now, there's a special feature here. This is actually a great place to pick good companies. Why? Because the industrial stocks that have survived until now in the US, well, you can generally categorize them as traditional industries. If you're grouped in this sector, within this group, it's quite similar to a traditional industry sector. But if you've survived until now and are still performing well, it means you're at a monster level. So within this group, you'll find sources of extraordinary returns. This is where the alpha comes from. Looking at that group, there are a few categories that have seen significant gains this year, and I expect they will continue to perform well next year. The first one is the aerospace sector. Companies like Gene Aerospace and Home, which is also an aerospace component supplier. These are related to airplanes, specifically high-value consumables or suppliers within high-priced products. These companies have protective moats, so they're relatively strong. Now, when it comes to the defense industry, we've always talked about this. My personal favorite, which I've mentioned before, is the only nuclear-powered manufacturer in the United States called HI. This is definitely worth your attention. Why is that? If Trump wants to build that Trump-class battleship, whatever he wants to do, in reality, only one U.S. company can build nuclear-powered aircraft carriers, HII. Nuclear submarines are also built by HII and General Dynamics, and then no matter what it is, whether it's the Ticonderoga class or the Arleigh Burke class, these are mainly being built by HAI. So HAI is a key player. That means as long as it's related to ships, any improvements in fleet efficiency, HAI will benefit from it. Now, moving on, Raytheon Technologies. This is a rather unique defense stock because its military and civilian businesses are roughly split 50-50, and this characteristic actually gives it an edge over, say, Boeing, which is about 70% civilian and 30% military. Raytheon's stock performance this year is still better, so you can see that in this environment, it's actually doing very well, especially during times like the US government shutdown when it's civilian business. The civilian division taking on new orders helps support its stock price, and if more government contracts come out later on. The government contracting division will also get involved, so this actually brings a double benefit. Now, in addition, L3Harris is a systems integrator. They mainly focus on fire control, communications, and command and control systems. They build and integrate these systems. They usually work alongside other platforms like ships or equipment or other types of systems. So generally speaking, I know about this company, but I didn't specifically mention it because for most regular investors, it's pretty hard to get involved with, but it is an old defense stock. There's still quite a lot of people who like it though. And then in addition, on the other side, the AI listed two GE energy companies. These are the original GE, GE Aerospace used to be one of the three parts after GE was split up. The original ticker symbol for GE was kept for GE Aerospace, and then GE plus an extra V is GE for Nova, which is translated as GE Energy. So this one has power generation equipment, right? You can see its stock went up by 102%. And then only Caterpillar, which makes machinery for building data centers, also went up by nearly 60%. So when we look at this infrastructure sector, I think these kinds of civil engineering projects, once they get started, they don't end quickly. Building a power plant takes about 3 to 5 years. So it looks like there are still opportunities next year. So everyone can keep an eye on the infrastructure related sector. Also, GE is splitting up again, doing another three-way split. One of the new companies is in healthcare. They're spinning off their medical equipment, that is the instruments and devices part, into a separate company. But after that spinoff, compared to GE Aerospace and GE Energy, it just doesn't look as impressive. Also, automation equipment performed well this year. Johnson, for example, saw a rise. Johnson Automation went up by 54.2, and Rockwell Automation increased by 38.7. Okay, and then in addition to that, this year some transportation stocks have also seen really strong gains, like CHRW and XEXPD. You might want to take a look at those. But I think for you in Taiwan, the most you can really get involved with, like I mentioned before, are the bigger ones, such as Johnson Controls from the previous page or Rockwell and similar companies. As for Cummins, if I remember correctly, they sell truck engines, and they've also performed well this year. And PPG, that's a specialty chemicals company, so its performance has also been pretty good. I'm just letting everyone know about these. There are a lot of details, so if you get the chance, you should look into them yourself. But since there are so many individual stocks here, some of the stocks that are really going up have a unique niche. For example, Howmet Aerospace, its US stock ticker is HWM. Previously, another one of our analysts also published a report on it. This is a relatively unique new type of company that's doing what we call an aero supplier. So what I'm saying is, this is really the source of excess returns when you're picking stocks. And when you find something this unique, it's less likely to be affected by market fluctuations. Right now, moving on to core consumer goods. This sector has been relatively weak this year, only up by 2.1%. It's pretty obvious why. It's mainly due to the impact of Trump's tariffs and the overall slowdown in consumer spending. This category has been noticeably affected. The ones with the biggest increases are Dollar General and Dollar Tree, and also Five Below, these so-called dollar stores, basically discount grocery stores. They mostly sell generic products and low-priced items. Most of the food you find there is pretty much all processed. It's mostly food that's full of additives and chemicals, and a lot of it is close to its expiration date. But because prices in the US are so high, these stores have actually done really well this year. But the problem is, looking ahead to next year, I might have to put a question mark on this. Because if Trump works hard to lower tariffs, grants some exemptions, and negotiates with China, then as long as costs are brought under control, the traditionally strong distribution channels should make a comeback. So this is actually a detail I wanted to add for everyone. And in addition to that, Monster Beverage, that's Monster Inc. Okay, so you probably know that energy drinks in the US are like Baima, Horlicks, or Merrycong, and also Polydor in the US, right? These are all energy drinks, and they're selling pretty well. Estee Lauder is also selling well, cosmetics, which isn't really a surprise. Then there are two more. One is Philip Morris. Actually, that's Marlboro cigarettes. Its international distributor is called Philip Morris. In fact, it's one company split into two. So they handle Marlboro cigarettes in the US, and of course there are others, but I've forgotten since I haven't smoked in a long time, so I'm not really sure anymore. So what cigarette brands are there now? I'm just telling you that this is a spinoff, but in the US stock market, this company, Philip Morris, has about 35% market share. As for slight increases, there's ADM, which is an agricultural commodities company, and Bunge, which is also in the grain business. But there are still some issues here with the US. The grain exports from the US are still not going very smoothly. Of course, looking ahead, if China really follows through and buys as much as the Trump administration expects in the first half of next year, then ADM and Bunge might actually have a chance to catch up and see some gains. And then there's Coca-Cola. No need to introduce what they do. Coca-Cola's gains were just a small uptick. As for Altria, like I just mentioned, it's the American tobacco company, and the US distributor for Marlboro was spun off from it. Also, I should mention, whether it's Philip Morris or Altria, both are doing well. They're all involved in the e-cigarette business, so honestly, I think a significant part of their stock price is determined by their e-cigarette segment. Now, moving on, let's talk about the companies with bigger declines. Clorox? Oh, that's the disinfectant company. Remember during COVID when Trump suggested people inject disinfectant? That's the company he was talking about. The name might not be familiar to everyone, but that's okay. Lamb Weston, this is the frozen potato company. People in Taiwan might find it hard to understand, but in the US, potatoes are as important as bread. They're almost a staple food. So this one has performed relatively poorly. As you can see here, most of these are food-related companies. I should especially mention a few alcohol brands here. Generally speaking, in an economic slowdown, alcohol brands are supposed to hold up well, but you can see that several of them actually haven't held up. For example, Constellation Brands, which owns Corona, is one of them. You know, Corona is the one where you put a slice of lemon or lime on top when you drink it. This year, its performance hasn't been good. The profits just aren't there. Another alcohol brand to mention is Brown-Forman, the maker of Jack Daniel's bourbon whiskey. They haven't performed well either. Even though bourbon is hard to drink on its own, it's actually a key base spirit for making cocktails. Really important. So the fact that it's not doing well probably also has to do with consumers being impacted. Another somewhat surprising one is Campbell Soup. You know, Campbell, the canned soup company. They're not doing well either, which is a bit unexpected. But this might be related to cost control issues. And Kimberly-Clark isn't doing well this year either. That's the situation. The subcategory here refers to consumer paper products like tissues, paper diapers, and Kotex, these kinds of everyday paper goods. This segment hasn't performed well this year either. I think this is probably related to their costs as well. Now, on the distribution channel side, there's something worth noting. For example, Poma and Costco. This year, their declines have been relatively small. Poma dropped by 2.7% and Costco by 27.4%. In the past couple of days, we've seen a bit of a rebound. Why is that? It's because of activist investors, those who buy shares and advocate for the rights of minority shareholders. If the management team isn't performing well, they'll push for changes together. They'll become board members and keep a close eye on the management team in the boardroom. Because of this, other minority shareholders might rally behind them. These activist investors exist in the US stock market too. There was a wave of them in the past, and there are still quite a few around now. But there are rumors that an activist investor has set their sights on Macy's and is getting involved. This could actually be a sign that the stock is bottoming out. But I still have to say, if we're really talking about the king of US retail, Walmart is still incredibly strong. And then there's Costco, which always does really well in Taiwan. This year, its performance hasn't been great either, but in theory, Costco still has a lot of strength when it comes to providing its so-called membership services. I think these are all things worth paying attention to. If the situation with US prices is well controlled and the economic outlook is also under control, then for those sectors that have lagged behind, you should watch out for the opportunity for them to catch up. So today, what we want to talk to everyone about are some more specific stocks. Mainly for what purpose? Well, you might be familiar with some of them, but I might forget to mention them. Some people might not be familiar, but these could be stocks you can do some research on. The main point is, what's the purpose? It's that if tech stocks are really struggling, then you actually have an alternative, another source of returns. This is an area that's really worth everyone taking the time to research. All right, so let's take a look here. I've got some good news for everyone. Not that the futures are down a little, the drop isn't big, but that yesterday we couldn't connect to Bloomberg, but today the issue was fixed. So let's take a quick look. The Dow futures are holding steady, as you can see here. The red area is basically staying at the lower end. For example, Mexico's is fluctuating more, but that's because yesterday there was no electronic trading yet, so we didn't see it. What I want to say is, looking at the Dow Mini, S&P Mini, and NASDAQ Mini, they're all still fluctuating at the lower end right now. It feels like things aren't very active up there, and there's really no clear direction. It just seems like there's still a slight drop, continuing to consolidate with a kind of holiday waiting atmosphere. Okay, now let's take a look at the sectors that are going up. Oh, sorry. Jacobs Solution has gone up quite a bit today, but there's no news about it. So, Manina, did you see the MOH I just mentioned? It rebounded today, right? Okay, so Michael Burry, the one who shorted and bet against the market, actually praised Molina, this healthcare stock. So it's relatively good. And then FCX, well, copper prices dropped too much yesterday, so Freeport rebounded. Newmont, the gold stock, also bounced back. And Teradyne, that's a tech company. This part is a rebound too. SMCI also bounced back. Halliburton rebounded as well. Halliburton, not Harry Potter, okay? And then this one, looking at EIX, just to clarify, this is Constellation Energy. It performed pretty well. And then we see BA, that's Boeing. It looks like it's friendly, but its gains have already shrunk. So if we look for bigger increases, it's mostly those that dropped sharply yesterday. As for the large caps, we don't really see much movement yet, so today it might still be the ones that are going up. Looking at individual stocks, it's basically a situation of small ups and downs. The one that dropped, PACC, I think is in the new energy vehicle sector, right? Its drop was pretty significant. Then there's Ben, which is Franklin Templeton Investments. Franklin, because you know Franklin's Chinese name is Fan K Lin, and that's why they use Ben as their stock symbol. So this one is down. As for PPL, I forgot what they do. I suddenly forgot, but this one also had a pretty big drop. As for the other stocks that fell, the declines weren't that significant. Among the more well-known or heavyweight names, we did see Microsoft. And we also saw Apple and Google as well. They all had slight drops. So today, it seems like the overall situation is more about small declines. So it's relatively. It'll probably stay about the same. The futures are showing us a slight drop. So if today is still just a small dip, tomorrow or the day after probably won't see any big moves either. As for the US dollar, it's still the same. Looking at the pre-market, there's not much change. It's still moving sideways. US Treasury bonds, well, they dropped yesterday, and today there's a bit of a rebound. Same with the 10-year. Next, let's take a look at the questions everyone has asked. The main one, okay, someone asked about silver. Let me address this first. I'll answer Xiao En's question here, because the regulatory authorities have reminded us that we can't comment on commodities. Don't overthink it, okay? What we want to share with everyone is this. We're not going to talk about prices, but we do want to mention that we've noticed the exchanges have already started raising the so-called margin requirements. After this increase, if the market is still too crazy, they'll keep raising it. Basically, when volatility gets too high, they want to cool down the speculative atmosphere a bit. Once this kind of measure is put in place, it usually has an effect on the exchanges. Yeah, then it will start to pull back. But expectations for rate cuts will come back later on. Also, the overall industrial sector is still showing a situation of supply not meeting demand. So as long as gold prices perform well again in the future and the gold-silver ratio gets pulled up again, then this. So that's why a short squeeze situation might happen again. So there are still opportunities for it to perform well. But in the short term, if you haven't entered the market yet, you might want to wait and see for a bit. I think maybe wait until it's not such a market focus anymore. That might actually be a better time to take action. So we might only be able to answer up to here. Well, that's about it. Looks like there aren't any other questions, so see you tomorrow.
Our company has no improper financial interests in the individual securities recommended or analyzed. The information in this program is for reference only. Investors should make independent judgments, evaluate carefully, and bear their own investment risks. If you don't want to miss the latest market updates, be sure to turn on the notification bell and hit subscribe. In addition, we have plenty of great video content on both Facebook and YouTube. Don't miss out. In our group, we share in-depth explanations of global financial events with you every day.